and welcome back to Cybos TV. We're continuing our conversation about all things regulation. And of course, it's not just banks who are affected by the avalanche, as we've described it, of regulation. Corporates are just as much. So to dig into that area a little bit more, I'm delighted to have been joined by David Cruikshank from BNY Mellon. David, welcome to the program. Welcome to Cybos TV. Carol Berndt, welcome from RBS. And Jana Bundy, very nice to see you, Jana, from Microsoft. And of course, as I've just been saying, it's not just the corporates who are struggling with this issue, is it? David, maybe come to you first. What do you think is going on in the corporate world? How have things changed as far as regulation's concerned?
Well, I think from my perspective, what we're seeing mostly change as a banker are regulations that are impacting banks, and then by extension, how they'll impact the corporate marketplace. Yeah. So as banks, we're being faced with regulations that are all well-intended and very often tend to be balance sheet led. So regulations around the asset side or liability side of a bank's balance sheet, and then exploring how that's actually impacting the decisions that banks take in their relationships with corporations. The flip side of that is that corporations then need to make decisions on their bank partners based on how that plays out.
And of course, whether it be fair or unfair, there will obviously be a suspicion that those extra costs are going to be passed on to the corporates.
Well, costs will be borne within the system, and that's a given. Will there be extra costs passed on to a corporate relationship based on impacts of costs on banks? I think that's a natural outcome. I don't think we're at the point of maturity of some of these regulations to understand exactly how that plays out yet, but with certainty we know there's an increase in cost in the bank ecosystem around some of the new regulatory practices coming into place.
Well, Jana, coming to you from your Microsoft perspective, how's the regulatory environment affected you? What differences have you noticed?
Well, for the past couple years, it's had significant impact on the Microsoft Treasury team as we look at the various regulations. So I could probably talk a full hour on the impact, and as I think about it, you know, we've had SEPA, we've had Basel III, we have money market reform, FATCA, FBAR. I mean, I can go on and on about the impacts to a corporate treasury and the things that we need to think about. Top of mind for us is really, because we manage an investment portfolio, so a cash and investment portfolio in-house, we are really looking at OTC clearing and the impacts of that. And there are costs associated with that, along with understanding the regulation end-to-end across all of your teams. So we really look at the impact across our capital markets team, operations, our risk team, our legal team. And you know, we've made a lot of changes the last couple years as we've begun to clear for Dodd-Frank, and we're thinking about, you know, the impact and implications of EMIR. So that's really top of mind for us. And what we've really seen from a corporate perspective is it does have a lot of impact. So you have all of these systems that you're trying to connect, having visibility to your transactions, and then really thinking about the cost of clearing versus not clearing. So those are the things I think that are top of mind for us. And then also, you know, I know on our panel that we'll discuss this afternoon, you know, Basel III, and as we think about the implications of that, of where we think about where we hold our cash and what we do with our cash as part of our portfolio.
Carol, listening to Jana there, I mean, she has so much in her intro which you wouldn't necessarily imagine a corporate would have. What's the role of the bank in sort of holding the corporate's hand, if you like?
You know, I think there's a very extensive and important role there. I mean, what we've looked at doing is providing our corporate clients with information, planning, and then support in execution. Jana touched on SEPA. That was a very good example of where something that looked exceptionally challenging to the industry and to corporates became a relatively successful project, albeit we've got more to do as we came together. So it's the information and the planning and the execution support.
And Carol, have you noticed any difference in appetite for lending? I mean, obviously, for the last few years, there's been constant stories in the press about banks' appetite for lending being reduced. But in this particular sphere, what are your thoughts?
Certainly, the regulatory environment makes us look at the cost of resources. And just like any product that's manufactured, you have to sell and produce it relative to its cost of production. Now, capital is a resource that we never really priced appropriately previously, and Basel III forces us to do that. And as we do that, we look to our relationships to work out which ones are accretive both for the client and ourselves. that does mean lending is not as free as it used to be. But what it will result in is deeper relationships, fewer relationships, but much more valued relationships.
David, do you think these consequences were intended or unintended? And are there other consequences that we haven't mentioned yet?
Well, when we look at things like Basel or the US extension on the SLR, the supplemental leverage ratio, I think the intended consequence is really in the bank environment. It's in the bank ecosystem. So was there an intended consequence to shrink bank partners or to reduce lending? My guess is there was not. Yeah. But certainly to make sure that we shore up the financial integrity of the system was certainly intended. But I completely agree with what Carol said. The impact of this is that there is a pricing mechanism now that didn't exist before. We always looked at things as banks, such as risk-adjusted return on capital, and now we're looking at the cost of capital without taking into consideration a risk adjustment factor, so we get an increased cost of capital against these particularly off-balance sheet unfunded commitments. And it's forcing banks, or I should say will force banks, to make some very difficult decisions as to which partnerships they want to continue to maintain. And it will, just as Carol said, shrink the relationship patterns, I think, that banks and corporations have together today.
Absolutely. Jane, I'd be interested to know your view of technology's position within all this. Can technology help corporates meet all these, that massive list of new requirements and in reporting? Yeah,
and one thing I'll just start, I want to comment on what David just said, because I also agree, or we agree from the Microsoft perspective that there will be impact to the bank relationships, and those will remain key. And I think it may mean that you work with smaller groups of banks, but I think we at Microsoft really value those partnerships with bringing information to us proactively about things we need to be thinking about. So the partners we look at would be coming and saying, this is what you need to be thinking about. We know your portfolio. We know how you operate your cash. Here's what you should be thinking about going forward of your impact to these reforms that are coming. As far as technology, clearly technology is key. It's very difficult to manage the infrastructure of what we need to do with all of the new regulation and having that visibility to reporting. So one thing that I will add is, I'll use EMIR as an example because there is delegated reporting that we highly rely on for our OTC, well, actually all of our derivative positions. And coming up with some type of standard across banks would be very helpful. I might even bring that up as part of a SWIFT initiative that they should think about, because those are key, because we really rely on good reporting for that information. But for us, we couldn't do it without technology. We look at being able to operate, straight through processing for everything, timely confirmations, visibility to, our exposures and our collateral. So I definitely think that's a key component to be successful.
Interesting. Carol, just sort of coming to the end of our chat now, let's look forward a bit. What do you think, how are relationships going to be affected over the next months and years to come, do you think?
I think they are certainly going to become more transparent. I think trust and transparency are going to be the hallmarks of going forward. Historically, we've talked about transactions, and the regulatory environment forces us to be more open with each other, more collaborative with each other, both within the FI industry, but with our clients. And when we have trust and transparency, we have great transactions, and that's great for everyone.
David, finally, how far down the line do you think we are? Is there light at the end of the tunnel yet?
Well, there has to be, right? You don't put anything new in place without assuming there's light at the end of the tunnel. I'm not sure we're there yet, because I think a lot of the new regulatory pressures that are being put on from a bank perspective have not filtered into the corporate treasurer's office yet. The knowledge is there, but the impact, potentially the cost, and then how they reallocate their relationship has not really filtered through yet. So I think we're still a little ways away.
Okay, well, on that slightly pessimistic note, and of course, I guess one thing to add is by the time we are at the end of that tunnel, there'll be a new regulation for us all to get our heads around. But thank you so much, Jana Bundy, Carol Berndt, and David Cruikshank for talking us through regulation from the point of view of the corporates. That's it on regulation from Sibos TV for this afternoon, but we'll be back with a special guest in just a couple of minutes.